All right, everyone. Welcome back to class 3 of the Day Trade with Tony trading course. Want to get started early if possible. And today I'm going to talk about choosing the right stocks. Okay, so we've already talked a little bit about I've introduced day trading, and we've talked a little about risk management, choosing the right stocks, choosing the right patterns. And the thing that we're really talking about in the last lesson was how to manage your risk in all your trades, and the fact that risk management is really the most important concept for you to understand in order to be a successful trader. Stock selection and your ability to pick good stocks is second to risk management, okay? But a close second. Being able to choose good stocks is important, all right? So in this lesson, we're going to review how to choose the right stocks. And this is really important because out of the thousands of stocks that are available to trade on the market, really, there's only really a small handful that I consider worth trading, because I have a very unique strategy for trading the markets, and it requires a certain set of stocks, and it's not going to work. In fact, the majority of stocks, it's just not going to work on. So we know that over 60% of the market volume in the markets is high frequency traders. It's the algorithms, the institutional traders. We know they dominate the markets. We know they're the ones that are making the money every single day. So as retail traders, we already have a disadvantage. You know, they're ahead of us. We're not able to trade millions of shares. We're not able to profit from the spread. You know, as soon as we buy something, we're immediately at a loss just because of the spread. You know, if there's a 5-cent spread, as soon as we buy, we're at a 5-cent loss. So it's really hard for us to find an edge in the market. But there is an area where I focus, and I feel that we do have an edge. And that's by focusing on patterns, right? Because computers are not very good at identifying those patterns. So retail traders like us, you and me, Joe Public, we can focus on patterns and use that as our edge in the markets. So the only thing is that pattern-based trading doesn't work on a lot of stocks. The reason patterns work is because retail traders are watching them. They're watching them develop. So as we watch, if we take a flag formation, for example, as we watch the flag forming, we see there's a very clear line of resistance, say at $12, and it becomes obvious to us that the buy spot is at 12, right? But if no one's watching that chart, then no one sees that pattern unfolding. So it's kind of like, you know, there could be patterns on stocks that have no volume, but they're not worth trading because they're not going to have good follow through. So not only do we want to find patterns, we want to find patterns on stocks that are going to have good follow through. What's the point of taking a flat top breakout if there's no follow through? So in order to reduce our risk of losing and you know, increase the probability that we'll be in winning trades, we have to focus on only trading stocks with high relative volume. Next slide. So with high frequency trading, not HFT trading, being 60% of the overall market, we know that it's going to be higher on some stocks and lower on others. There's stocks where there might be 80% high frequency trading. So the volume is all hedge funds and institutional trading. And there might be other stocks where it's only 30% or 20%. So it's not to say that high frequency trading is necessarily our enemy. It's just that high frequency traders are not going to participate in the breakout trades, and that's what we're interested in trading. The people that are going to buy breakouts are retail traders. So we want to focus on stocks with lots of retail traders, and we don't want to get fooled into buying patterns that are being formed by high frequency trading, because those patterns are just the result of the way that the computers are shifting their shares. It's just a coincidence that we're able to see a pattern, really. It just happens to be there. It doesn't really mean anything. So what we have to focus on are the stocks with high relative volume. That's how I identify a pocket of safety in the market. I only trade stocks with high relative volume. So that is one of the most important things to take away from this class today. Only trade stocks with high relative volume. And we'll go into defining relative volume in just a few minutes. Okay. So, in other words, trade high relative volume. We only trade extreme stocks. So that's how I combat the high frequency trading. I only trade extreme stocks. So if we look at almost any single stock, you'll see a day on that stock that it had a huge volume spike. And usually that correlates with a really big percentage gain or a percentage loss. Those are the days that we trade that stock. That stock, 365 days, well, there's not that many days to trade, but over the last 52 weeks, you look at every single day on the chart, on the daily chart, and you might only see 2 days where it's really had heavy volume. Well, those are probably the only 2 days that we would have traded that particular ticker. So the rest of the time, it's just resting. It's just trading sideways, choppy. It's just trading. There's high frequency traders, trading it. There's the swing traders maybe buying it. Value investors may be trading it, but as day traders, as high speed day traders, we're not going to be interested. We don't want those stocks, except for 1 or 2 days a year when they're having a major event, whether it's because they've reported good earnings or there's some other news catalyst or whatever the reason is. Those are the only days that we will be trading those stocks. So what we're looking for is stocks that are making extreme moves. We'll look for high relative volume. So it's if we look at the average volume across the normal year, it's got to be trading much higher than that. And the chart patterns that we tried, they work on these stocks better than they would on the lower frequency, the high frequency traded stocks, the lower volume stocks. So if you look at some of the high cap stocks, for example, which are only have a high percentage of high frequency trading taking place, you'll see that these patterns don't work at all. So we have to follow the volume. We follow the volume in the markets. All I do all day long is chase volume. I look for volume. I'm scanning for news because I know news creates volume. I'm just scanning for volume, and then sometimes I have to go search for the news. I may not know what the news is, but I see a stock ripping up, and I want to figure out why. What's the catalyst? So I try to find out what news event is actually triggering that move. But all I'm really doing is following the volume. I'm just chasing the action around the market. There's usually a small handful of stocks each day that have tons of relative volume. There's tons of day traders, but honestly, we all trade pretty much the same stocks. We're all looking at the same thing. If you talk to other day traders any given week and you ask them what stocks they're trading, the odds are they're going to be trading pretty much the same names that you're trading, that I'm trading. We're all looking at the same stocks, and there's a reason for that. It's because those are the names that are easy to trade right now. They're the stocks that have lots of volume and are very, very volatile. But they're volatile in a way that's relatively predictable because they're going to trade in these patterns and patterns that we understand. They're going to form both flags. They're going to form flat top breakouts. And whenever we see one of these familiar patterns forming, we know how to trade them. And we can incorporate that pattern into our strategy of how to trade momentum stocks. So, now there are certainly stocks that are going to be spending this. There's certain traders going to be spending this week trading the VIX or trading the SPY, and you know they're going to be trading commodities, and that's not something that I do. I don't apply my strategies to that type of stock commodity. I don't do forex or anything like that. I don't apply it to financial instruments that don't have a lot of volatility. I don't apply it to a financial instrument that doesn't have a catalyst for a big move. Now, you know, if there's a catalyst in one of the futures, for example, I wouldn't trade it because I don't trade futures. If there's a catalyst in the SPY, for example, well, you know that's going to be a global catalyst. And typically, I don't try to trade those because, for me, they're just too difficult to trade. You know, there are times where there are going to be times like, you know, think about the Ukraine situation right now, or go back to 2012, 13, 14, etc. When we were talking about real impactful global events, there'd be a lot of volatility in the market, and we would see the SPY suddenly tank, and then it would shoot back up again. Last week, we saw Russia invade Ukraine, and as that happened pre-market, the markets just sold off, and then the wider global trend was to start imposing sanctions, and they just rebounded. They went as low as kind of 3% down and finished the day 3% high. So it was like a 5-6% swing. You know, yeah, there was an opportunity to scalp, you know, that breaking news, and basically we could scalp, you know, the same as we would scalp any other news on a day-to-day basis. But I wouldn't be trading it. I wouldn't be trading the VIX. I wouldn't be trading the SPY because they're going to be very choppy. They don't have a strong individual catalyst to make those clean moves. So I only want to trade stocks that are going to have ideally perfect setups. You know, we're not always going to see perfect setups, but I only want to trade the best setups because, look, the reality is, even when you only trade the best setups, you're still probably only going to be right 65 to 75% of the time, at best. And that's why you're trading the perfect setups. If you're trading the less than perfect setups, I mean, just think about it. How quickly a percentage of success is going to fall, right? Maybe 50, maybe 40% success. So why waste your time trading subpar setups? Or trading stocks that don't fit our criteria for being a stock that's worthy of trading. Now, similarly, I don't trade penny stocks. And, you know, chart patterns are almost irrelevant when you're talking about penny stocks because typically the penny stocks are highly manipulated. So any of the moves are just going to be, you know, people manipulating the price of action. So patterns that you see are pretty much worthless. You can't trust them. And from a technical analysis perspective, the stocks don't respect those patterns in the same way. So I don't trade penny stocks. I wouldn't apply these strategies or patterns to any penny stocks. So no penny stocks, no funds, no ETFs, no index, none of those types of trades, no commodities, and I don't trade forex. Okay, so there's a lot of stuff I don't trade, right? This is a low volume stock here. This is an example of a stock that on a day-to-day basis that would be totally wasting our time to look at. So this has a 500,000 in volume, right? But what can we take away when we look at this type of chart pattern? What does this tell us? I mean, we see it's very sporadic. Bursts of volume here, and you know, nothing there. It's a little burst here and a little burst there. What is it going on here? I mean, this to me is just a stock that has almost zero retail interest. Has a few buyers here, but there is basically no interest, and only people buying it might be people that have a long-term position, and they might be random log on and add a couple of shares or sell a couple of shares. It could also be the high frequency traders shifting shares a little bit. So this for me is a low volume example of a stock I just wouldn't trade. There are times when we'll take a trade on a stock that only has 500,000 in volume, because all that volume came in a period of about 3 minutes, right? A volume surges in because there was breaking news or something. That could be worth trading. But a stock where we look at this and, you know, 32, 30, you know, 3:20, 3:30 in the afternoon, it's just not worth trading at all. So most new traders, both, you know, or people in the chat room that I've talking to, if you were to call out a stock like this to me in the chat, for example, check this out. I'm going to say right away, no, it's not a stock for me. I've done it. Somebody called a stock out the other day. I looked at it, and on the daily, it was making moves, but intraday there was just no volume. And I said it straight away. There's just no there's no setups for me. It's not something that I would trade. If you're looking for a swing trade, great. If you like the stock from a value perspective, great. But it's not for me. It just doesn't have enough volume. So any pattern you think you're seeing is just not worth it. Here's a high volume example. I've just gone past it. In contrast, this is a stock called Zillow, right? And there was a day where it had a big surge right out of the gates. Where have I gone? Just give me a second. I'm just lost my chart here. There we go. I do apologise. So this is a stock called Zillow, and it had a day. It surged right out of the gates, and you see there. We can see. You can see there, this stock is a stock that's worth applying the patterns to, because it's heavy volume. You see the volume spikes here, and here it's in an ascending wedge or a flat top breakout, and there's a higher likelihood that it'll resolve in our favour because more people are watching this stock. It has higher volume. This stock not only had high volume, it was on some good news. And you look at the volume, right? And they might be hard to see, but on this candle, it broke new highs on big volume. And you can see this, the last bar. And it had a big volume spike of about 40,000 shares. So that's the confirmation that people are indeed watching this stock and waiting for that breakout. So there are times where it'll seem like it's very light volume. You might ask yourself, is anyone watching this? I mean, I see that we're trending up here, and sideways here. But is anyone really watching this? And then maybe you buy it at 18, 118, 117.99, and for that whole dollar break, and breaking that whole dollar of resistance, being the flat top, you suddenly see this surge of buyers come in as we move up to 119. So you see that, and then we see this all the way up. This is the volume histogram at the bottom. It goes all the way up on the back of that move to 120. So that's the type of chart we're going to look at. That's the type of stock that's worth trading on relative volume. Lots of high volume. Okay, so what creates high relative volume? High relative volume is the result of a catalyst. So relative volume is simply what is average for that stock and how it trades on the average day. Relative volume for every stock. Some stocks trade with a ton of volume, like Bank of America, or other stocks trade on very light volume, like Zillow that we just saw. You know, with 1.8 million shares, and that's pretty light volume. Now, I'll just check how much Bank of America traded last. Just give me a second on a different monitor. 100 million shares today. Bank of America traded 100 million shares, but it only moved, like, it had a daily range of about 40 cents. So 100 million shares didn't really make much of a move at all, which, considering 100 million shares traded hands, it's because, and that's relative volume. It's also to do with the float size as well. So let's 103 million shares. So considering that much volume, you know, 100 million shares traded hands, it really didn't make a very big move, in contrast to a stock that relatively light volume and actually had a lot of volume today. So let's look at an NDRM. This is a stock that moved up a few days ago, about 200% in one day. And let me just see. 41 million shares. So 41 million shares, and this went up 200%. So volume is relative. 41 million shares compared to Bank of America doesn't sound like a lot, but for that stock, it was a lot of volume. So in Benzinga, we can actually see what the relative volume is, which is actually a numerical input. It just puts it there in front of us. We can actually look at what the average volume is, what the relative volume is, and we can scan for relative volume. Okay, so when you set up your scanners, you can just look at volume surging, or you can look at the relative volume, and if it's flat average, it's on a par with its typical volume. It's probably not going to move very much. Okay, so I look in general for a relative volume of at least twice the average volume, but the higher the better. More relative volume means more people are watching this stock than usual. So why would more people be watching this stock? Well, it's simply because there must be news on it, right? There's either breaking news, earnings, an activist buyer, future investment. It's possible that the stock is just experiencing a technical breakout, but typically a purely technical breakout is not going to bring in the big flood of buyers the way earnings or breaking news would. So if something is breaking but it doesn't actually have any news on it, I'm usually going to be a little bit more cautious, and I'll still keep it on watch, because there's always potential we can get, maybe a short squeeze where stock just irrationally starts running and the shorts have to cover. and that does happen from time to time. We saw it last year with GameStop. We've seen short squeezes happen in the past on a number of occasions, but probably the biggest, most high profile one in recent years was GameStop, ticker GME, and that was highly shorted. And when the price started to move up on high volume, the shorts had to cover, and it caused a short squeeze. But what we're going to see in most cases, we're going to see the cleanest moves on stocks that have an identifiable catalyst. All right, let's see. Sarepta. There are now the times when a stock is going to be of absolutely no interest to us. Well, I say no interest until 12:51 or whatever time it was. Big news comes out, breaking news. So here's Sarepta. It had absolutely no volume all morning, and then just after lunch, 12:50, 200,000 shares, and it spikes. 22.50. The price was 22.50, and it went up to $24. So it spikes up a point and a half, pulls in a little bit, and then makes another run. And all of a sudden, in the middle of the day, a stock that was of really no interest to us comes into play. And now Sarepta is on our watch list as a candidate for a midday trade. Now, typically, as you know, I tend to trade only in the mornings. And only if I'm going to trade in the afternoon, it's only going to be something that has a very high relative volume and is an extreme type of chart pattern. So I'll trade something in the afternoon that has a really big bottom bounce, a stock that's just washing out, and I'm waiting to catch the bottom of it. Or I'll trade a stock like this one, so Sareptos, that has breaking news that are really basically, these are the only patterns that are worth trading in the afternoon, because typically the afternoon volume is very light. So even if a stock has high relative volume on the day, the volume between morning and afternoon, it's always going to be heavier in the morning, unless you have something like here, Sarepta, that has the news. So we had a news play today on DKS, and we'll take a look at that in a minute. All right. So let's see. Here's a good chart of Sarepta. These are the days that we've traded Sarepta. I'm familiar with this stock because I've traded it several times in the past. And you see the green arrow. We traded it on the day it had breaking news. Midday we traded it on this day that it had a big gap down, and this day it had a big gap up. And then so this was the breaking news day, this was the big gap up, and this is the big gap down. So those are the days, and it looks like a year or so, really. So there's 3 days in that year that it was worth trading. The stock was on our watch list because it was either a big gapper or it had breaking news. So on those days there was tons of volume, and tons of retail traders like all of us were watching the stock, waiting for patterns to form, where we could just jump in for a low risk entry. So the simple thing is, you might well ask, why is everybody watching this stock? And the simple answer is, people are watching this stock because it's volatile, because it's going to move a lot. If you're willing to take 20,000 shares, there's a potential that this stock on a big day will move 3 or 4 points, and you can make $60,000. You make $60,000 in that move. So there are big traders with deep pockets that are going to be interested in these types of stocks every single day, because this is where they can make a ton of money. So for us, you know, we might not have those big sized accounts, so we may only take 2,000 or 3,000 shares or something like this, but we see the same opportunity for a big percentage gain. So whether you're trading 2,000 shares or 20,000 shares, the opportunity and the potential for percentage gains is exactly the same, right? So that's why we're all focused on these big, fast-moving stocks. So in the morning, my scanners are focused in on gaps. I look for stocks that are gapping up. And a gap is simply a stock that's opening higher than it closed the day before. So overnight, there's going to be price gap, and on the daily chart, you'll see this. You'll see this little window here, and we call that the gap. Sometimes I call it a window or a little pocket. It's a little pocket between the close price and the opening close price the previous trading day and the opening price today, and there's absolutely no resistance there. This little pocket is so stocks gap up because they have good news. And that's usually the news is released after the market's closed, or overnight, or before the market opens. And just next thing. So to find these stocks, this small handful of stocks each day, I use stock scanners. I use Benzinga. I keep telling everybody about Benzinga, and I've got my with Benzinga. I look primarily for gappers, and then I look for the momentum. But I also look at the calendar for earnings, because periodically you'll have these periods where people are releasing the quarterly earnings figures. So I look for earnings. And then I've got my surging scanners, and I sort by volume. So I've got scanners sorted for looking for volume. So as soon as I set up my platform each morning, I have the same routine. I look for gappers, and I look at stocks that are reporting earnings. I look at so this is Benzinga, for example, and I'm scanning for here on this one. I'm looking for stocks that are on the pre-market session are gapping up at least 14%. But here I've got the calendar, and it's got the earnings. So which stocks are announcing earnings as well. So that's what I've got here. Earnings plays, when we're in earnings season, have a lot of companies reporting earnings, and that can be a catalyst in its own right. The earnings are a little bit slower, so the gappers have been more based on other types of news than instead of earnings. In most cases, earnings can trigger a gap up, but more often than not, it's either earnings plus another catalyst, or it's another catalyst entirely. Okay, the gaps that I look for are usually greater than 14%, so 15% and above. I find the bigger the gap, the better. So for the gap and go strategy that I like to trade, I want to see something that has a big gap up and has a lot of buyers interested in it. And then as soon as the market opens, look for that continuation. Gaps of less than kind of 14%, 10%, oftentimes they're good candidates for a retracement or a gap fill. And a gap fill is if I just go back to this one. Yeah, so the gap fill, I just want to show that on here. If I go back to this chart here, when the price in this window it fills, the action comes down and it taps this lower line. Okay, so gap fill is very common for stocks that are gapping at a lesser extent, and I'll just go back to where we were. And you know, if they tend to sell off at the open, so gaps that are you know, stocks that are gapping up, you know, 15% or more have a higher likelihood of running and going higher. Okay. Now the other thing I scan for is simply pre-market volume. Sometimes there will be a stock that's gapping up, you know, 3.5%, but it's on 3 million shares. So it would slip through my gapper scanner, but I still want to be aware of it. So I scan also just for the leading pre-market volume, and I sort it by the highest volume, and I look for that. And I look at the stocks with tons of volume. Anything that's with light volume, I'm not interested in. The only problem is that on that scanner, I will sometimes get stocks like Citi, which maybe only be gapping up a percentage or two. It's got a ton of volume because the stock in general trades a lot of volume. Bank of America, we were talking about earlier, is the same sort of thing. It's got a ton of volume, but it's not going to move very much. Okay, it's the relative volume is not so high. So that's what we're looking at. So we need to filter out what the relative volume is. It needs to be gapping up a minimum amount. And it needs to be having a minimum amount of volume as well. So in order to find the stocks worth trading each day, just next slide, how do I create my watch list? How do I find the stocks to trade in each day? My process for creating a watch list is to first look at the top gainers, the top pre-market gainers. So the stocks with the biggest gap and the stocks with the most pre-market volume. I simply mark out the high of the gap up pre-market, and I look at that spot. That I even place often place a line, a horizontal line there, so you can actually see that. Okay, I mark out that's the place that I potentially could be looking to buy. So if a stock is gapping up, has a pre-market high of 17 and it pulled back to 1680. 17 is the spot that I'm looking to buy it, right? I'm looking for a new high. I'm looking for a break of that pre-market high. Looking for a break of that gap, if you will. So it's got to break 17 and then squeeze. So I'm going to have my watch list marked to have maybe even have a buy order all set ready to go at 1701 or 1702, and as soon as that comes up with volume, I'm going to be interested. So I like trading the breakouts. We talk about the patterns, and breakouts are a form of patterns, and you mark the previous high, whether it's a range high or pre-market high or opening range high. I like to trade the breakouts. The breakout of the pre-market flag. That's one of my favourite setups for the gap and go. And if it's gapping up, a stock that's gapping up has a really nice flag pre-market. So a stock that's gapping up but has a very weak flag pre-market, say it gapped up to 17 and then pulled back to 15, well, we're 2 points off the high there, $2 off the high. So I can't wait for it to turn around and go back to 17 because I'm going to be chasing $2. You know, I'm waiting for it to chase $2, and I don't really want to buy at 15 because it's retraced $2. I mean, that's kind of a sign of weakness, isn't it? So going back to what I was saying about trading the best setups. So on those ones, I usually decided that it's retraced too much of the move. It's lost too much of its gains, and I'm not going to take the trade. Okay. Also, when I'm looking at my watch list, I try to see if there's any stocks on there that are former runners. Stocks like we were talking before, Sarepta for instance, that I've traded in the past and had really big days. Stocks that when they gap up historically, they go crazy. Those are stocks I'm going to be excited to trade. So, for example, we come into the market tomorrow and we see a stock like GGLY, LAKE, NDRM, JRJC, DWAC, anything like that, then those are just a few. If any of those are gapping up big time, I'll be excited because I know that when they have big days, they can get pretty wild, and that can be a lot of fun. And if my watch list has stocks that in the past I know have been kind of weak and not fun to trade, like ones where I've lost money in the past, PUHN has caught me out a few times, then I'm probably just going to say, do you know what? This is gapping up, but I'm going to leave that. I'll put it on my no trade list, if you will. It's not easy to trade. It's choppy. It has a lot of market manipulation. So I'm just going to avoid it. It's good to get a little bit of a list going in your mind of stocks that are easier to trade for you and your trading style, on what stocks that you historically make money on. 9 times out of 10 when you trade, then also stocks that you're going to lose 9 times out of 10. Well, they should be on your no trade list. So just make a note of them. Make a note of them. Okay. Look at a former runner here, DGLY. This is an older chart, but still, we had this stock that was a former runner, but made a move from $4 up to $33 in the period of like a week. Okay, so anytime this stock gaps up, lots of people jump on it because it has a very low float, and there's potential that every time this one gaps, that tons of buyers are going to jump in and it's going to squeeze 20, 30, 40%, maybe more. So anytime there's a stock that has a history of making big moves, retail traders are going to remember that. And the retail traders that are thinking, you know what, I could buy 30,000 shares of this thing and maybe it'll squeeze three points. I'm going to make 100 grand, right? There are traders with big money. They're going to see a stock like this and think it has huge dollar signs written all over it. So for us, again, we might only be taking 2,000 or 3,000 shares, maybe more, but the percentage, the percentage game, the potential is still there, right? So we're going to focus on the same stocks that the big money is going to follow, because we all know these are the ones that have a lot of potential. Now, it's worth noting follow-through days. They can be good, but they can also be risky. And we talked about this a little bit when we were talking about managing risk in the last in the last lesson. We were talking about risk management. A follow-through day is the day after a stock has had a huge move, and typically the day after, the stock's going to trade only at a fraction of the volume that it traded on the first day of the breakout. So let's say the stock trades 50 million shares on the breakout day, but on the follow-through day, it's probably going to trade maybe 25 or 30 million shares. Now, that might still be a relatively high volume day, or a high relative volume day even. But compared to the previous day, the price action is always going to be choppier. The exception is when the stock breaks to make new highs, because when it makes new highs, fresh buyers are going to jump in. Shorts are going to have to cover, and you can get a really nice squeeze. So when I'm looking at the follow-through days, I focus primarily on new high breaks. And we'll look at a slide here. And this is a stock called Lakeland. Okay, so the big day here. There's a couple of big days, and I guess the biggest day was this one here. Okay, and the follow-through day had much lighter volume, but it did make new highs. And when it broke over 20, it immediately popped to a point. So lots of buyers came in and jumped on it. Shorts covered and it squeezed. Okay, the next day it gaps up again, and then it sells off a little bit, and then surges up again, and it continues to be on lighter volume than the first breakout day. So even though it was a big percentage up, it was a little harder to trade it on this day. Okay, and on this third day of the breakout. On the fourth day, we're starting to get a little bit of a sell-off. So this is a red candle as opposed to the three big candles. This is a red candle. So we're getting a bit of a sell-off, okay? And this is common. This on the fourth day, it wasn't able to make a new high. It wasn't able to break the previous highs. And if it did, it only broke like a couple of pennies or something. And then it pulled in. Okay, so this is common when a stock's getting a little bit overdone, and we can see on a daily the stocks will surge up and they'll have a big move. Bit of a pullback, tapping the average volume weighted average price, and then they'll you know, if we're watching it on the first day and let's say it breaks 15, okay, this is going to be a day that shorts they're going to have to cover. There's going to be a lot of upside. There's going to be a lot of potential there, but if we break the high of the previous day and then we sold off, we're going to be disappointed. So just be wary of those follow through days. They're not always as volatile as the breakout day. Okay, so the gap and go. We'll go over this more when we're talking about the actual strategy, but just in general, take note of the fact that stocks gapping up over 14%, 15%, we often see the pattern called the gap and go. They gap up and go up. These stocks, they gap up and then they surge out of the gates with a tremendous amount of volume. In contrast, stocks gapping up less than that amount, so if you're getting kind of 12, 10% or less, they often sell off and they fill that gap. I'll review that a little bit more in one of the later chapters. It's kind of a gap down, go down stocks that gap down more than 4%. They often are also going to fill the gap and pop back up. So I find this a little bit interesting that stocks that have a big gap down, they often pop up at the open. So it's kind of the opposite of what we're seeing here. So we've got stocks that gap up, the gap and go strategy. They stocks that are gapping up a decent amount, they will then launch out of the gates. But stocks that are gapping down a sizable amount, they will bounce and they will pop up at the open. So they will have a reversal, if you will. Okay, I'm not sure exactly why it is, but if it's people that are covering the position or people that are averaging down on their long positions or people that see a big gap down, it's possibly a buying opportunity. I don't usually see the quick drop right out of the gates with those big gaps down. Um, it's just one of those things that I see. So a big gap down. Honestly, there are a lot of times where I look at these as buying opportunities because the stock. So when we're scanning for gappers, you know, I tend to look more for you know, up gappers. But if we're not seeing that, we can actually just look at the down gappers as well. Okay. And it could be because the stock now is selling at a discount. You know, I have a general long bias, meaning that I tend to you know, buy high and sell higher. So that's one of the reasons that I look at it like that. But stocks gapping down more than, you know, 5-10%, it can be a buying opportunity. So in general, I try to trade with the trend. You know, I'm gapping down, so obviously the sign of weakness there. There's a reason it gapped down, so I'm going to avoid taking that kind of trade in most cases. I would take the trade like if there was nothing else that looked good, but I'd still go in with smaller size. But only if there's potential there. It's not my favourite. It's not my favourite type of trade. The gap down, go down. Not my favourite type of trade. I will look at it, but if there's gappers moving up, there's no reason for me to look at it. You decide. I'm telling you a little bit about this because you might want to decide that this is part of your trading strategy. So just bear that in mind. So if it's gapping down kind of 15-20%, there might be a pop up. Not my bread and butter, but it's still nice to have that tool in the armory. Okay. Watch list. So once I have my watch list each day, I'll keep those stocks on watch. Well, I'll keep them on watch until they prove to me that they're not worth watching, because that does happen from time to time. Now, if you think of this you watch 4 stocks all day, you watch them all day long, you're guaranteed that if a pattern forms, you're not going to miss it, right? That's why I have one screen full of, so I have my watch list on my trading platform, and I'll have 8 windows open. Now, there's no guarantees I'll get 8 stocks, but I'll have 8 windows on a 1-minute time frame, and I'm watching them. I'm not studying them. I'm not looking at them for any particular data while I'm trading. I'm just keeping them on watch. Okay, so if any patterns start to form on any of those that are on the watch list, I'm not going to miss it, because I'm actually staring at them all day long. So watching those stocks on the watch list with the highest relative volume can be a good opportunity to find trades that typically I'll be able to find a trade opportunity in one or more of those stocks at some point during the day. So, you know, if there's a point where one stock, for instance, starts selling off and you initially had it on a long bias, well, you can take it off your watch list. Replace it with a stock that maybe wasn't gapping up, but right out of the gates had a lot of volume and moved up. So it's now on the watch list, or a stock that's had breaking news intraday, and you know, a big price move following that. That's worthy of watching. So as the day progresses, your watch list becomes fluid. You may add stocks to the list, or you may take them off it. We can adjust our watch list throughout the day. The market is fluid, so you need to operate fluid, right? So with breaking news, as you guys should know, I listen to Benzinga. I have Benzinga scrolling. I have the news ticker on Benzinga in real time. And people have watched me streaming will know that I'm constantly looking for Benzinga, and they have a breaking news functionality. And if all you're doing is watching breaking news, it can turn a boring day into one of the biggest days of the year. It really can. If you look at this last week, we get news on a stock, and it news of a potential merger, and it runs. So breaking news can be a major catalyst, but we do have to be selective about what news we're willing to trade. Okay, if it spikes up on breaking news, what I'm saying to you is sometimes there's a saying in trading that you buy the rumor, sell the news. So sometimes the news can fake you out. So it's always better to be aware of the news and then watch. Don't jump in on right away. Don't jump in. Watch for a potential pattern to form on the back of that breaking news. We're still looking for those patterns. We're not trading the news. We're trading the catalyst. We're trading the reaction to the news is what we're looking for. So the news is the catalyst, and we're looking for the pattern to form on the back of that catalyst. So don't just jump into a stock just because there's news, and it seems to you like it could be good news. Okay, you need to be conscious of the fact that not everybody will be trading it. If a stock's going to break out and make a clean move, you need to be aware of it, but it can be on the back of a catalyst, but you want to watch for the patterns forming first. Okay, so that's breaking news. I listened to Benzinga. I'm just conscious that news can fake you out quite easily. And you get an initial burst in momentum, and then it will completely reverse. So just be wary on the breaking news catalyst. So I've tried to take trades on breaking news, and I've been willing to take it because of the initial surge in volume. Okay, but once it starts fading, it's fake you out. So it's probably better if you didn't take that trade in the first instance, or if you got in on the initial trade, on the initial volume surge, maybe don't look at a secondary trade because it's starting to sell off. It can be wary. Okay, just be wary. Sometimes a news trade or news will cause a stock to spike up, and just it's not really good for a trade if we can't get a tight stop, or the volume dies out really quickly after. It's just not worth touching a stock in those circumstances. So we do have to be selective. We don't just want to be trading any breaking news. Okay. The trades that we take, here's the whole thing here. What we're looking for with the news is that it can be risky when a stock suddenly jumps. If it jumps up, say, to $2, if it goes right back to where it came from and we buy at the highs, we could be having a really big loss. So the safest way to trade this type of news is just wait for the first pullbacks, wait for the patterns to form, and look out for the entry signals. Buy into areas of support if possible. That's when the smart buyers are going to come in. And if we see a lot of volume coming in the first pullback, for example, we know that those smart buyers are jumping in, and so they must know and be able to recognize that this news is strong and worthy of buying up. So then's when we want to join the smart traders. Let's not be one of the impulsive traders that just buys news as soon as we hear that there's news on XYZ, and then all of a sudden be down a dollar and a half or on 2,000 shares. That can be just really risky. Okay, so then to answer a question, I really do try to always wait for the volume to pick up before the breakout. Now, if the stock has high volume during a consolidation, then that's something I might look at taking a stab at, because it already has really high volume on the day. There are times where I will take a breakout pattern, but it's really going to be a case by case. It's going to depend on the daily catalyst. It's going to depend on the daily chart, how many people I think I'm watching it. If it's had low core volume, and the time that we're looking for the breakout, I just didn't have the confidence. Well, if I didn't have the confidence it was going to go, I'd just leave it. I'll wait for the setup. I'm not going to take it if I'm not feeling the setup. So I have been asked another question as well. So why is it that there's stocks that have big pre-market volume and gap up, but then little volume after the market opens? It's a good question. Sometimes a stock is going to gap up, and there's going to be some news pre-market that causes the gap up. Then once the market opens, there's just not a lot of retail traders interested. So whoever was buying pre-market, sometimes there'll be a stock that has 500,000 shares of pre-market volume, and it all came in 1 minute. So it was, it's like one buyer that came in, and they bought 500,000 shares, and no one else aside from them really cares about the stock. The whale, we've got a whale come in and bought up a huge chunk of the stock. So that can happen sometimes. And it's sort of a group mentality where if we have 10 stocks that are all gapping up really nicely, inevitably whichever one's moving the fastest is going to get all the attention. So even though the fourth or fifth one might be a nice gap up, it just might not get as much attention because there's something else that looks better. It could also be related to overall market conditions. If it's a kind of a weak day in the wider markets, or the market is selling off right at the open, people might be a little bit more cautious, a little bit more hesitant. That could be another reason. So, for the most part, the stocks that have a lot of pre-market volume, and when we talk about a lot of volume, one of the measures that we can look at is the float of the stock, is how many shares are outstanding. And we can look at what percentage of the float has traded pre-market. So stock that has a float of, let's say, 10 million shares and is trading 1 million shares pre-market has already traded 10% of its entire available float pre-market. So if we look up that stock and we find that there's some good news, some good catalyst on it, there's a really good chance that it's going to open and really surge out of the gates. On the flip side, a stock that has a float of maybe 75 million shares and is gapping up on like 30,000 shares of volume, when the market opens, it might not, well, it may, but it might not attract as much interest, or it just may not have as much potential on it on the daily chart. It may not be as good, and people may not see that and not be as interested. So if a stock with a high amounts of relative volume and one that's probably the one that's going to get the attention instead. Okay. So stock selection. So remember, when you're looking at your watch list, and when we're looking at the stocks that we're going to trade, we always want to trade stocks that have the potential for a big winner. and I'm not swinging for the fences. I don't want to be swinging for the fences every time. I'm not looking for, when I say I will look for the potential for a big winner, but we're not swinging for the big winner every time. Okay, I'm just trying to get basics. That's all I'm trying to do with my trading. I'm just trying to get, a couple of hundred here, a couple of hundred, 150 here, 300 there, 250 here, 200 there. Occasionally, I'm going to get a really nice winner where I'll get a couple of $1,000, $2,000, $3,000. But typically, I'm just trying to get, I'm just trying to get me on a base, get a $500 winner. Just get a little something out of the gates, and then give me that little cushion on the day, so I can start being a little bit more aggressive with my trading. But if a stock doesn't have the potential to be a big winner, then that's a problem. Because let's just say the profit potential on a stock when we look at our profit target is, let's say 50 cents. Well, we know we're never going to catch the bottom, and we're never going to catch the top. We never get the full move. So if we're able to capture a fraction of it, we're able to capture even half the move. That's a pretty good going. So in that 50 cents, in that case, 50 cent case, or that 50 cents example, that target, we're going to look for half the move. So that would be 25 cents. So that's not a huge profit window. But that's something. On the flip side, we can have a stock like that's moving up, 8-cent blocks. It moves up 8 cents, then comes down 5 cents, moves up 8 cents, and comes down 5 cents. It's really hard to capture profit. If it's choppy like that, it's tough. It's tough. When the moves are that tight, you have to use larger size and take smaller wins. But then you really don't have that home run potential unless you're willing to give it just a lot of room to breathe. Give the trade room to breathe. A trade like that is called what's known as stir stepping. So it's a large step up, medium step back, large step up, medium step back. So it's stir stepping its way up. And we want stocks that have home run potential. We're not swinging for home runs, as I say, but we want it to have home run potential. We also need to be able to apply our risk management techniques. We said it in lesson 2 that risk management is the most important thing. So we're looking at risk management techniques. Any stock that we're considering trading, and there's a few stocks that are in the, say, $250 price range, that when they have a big day they can move $50 or $60, but they're extremely hard to trade because they have $1.50 or $2 point spreads. So if you've got a spread and it's like $1.50 to $250 spread, that's a big spread straight away. So on one hand you could think, well, look, this has the potential to go up $30, but realistically managing risk on it is going to be extremely really hard. Okay, so stock selection essentially is our second level of risk management. In the last lesson, we were talking about the first level of risk management, how to set up stops and how to find profit targets and risk versus reward ratios, etc. Using a profit loss ratio and using that to manage your risk. And how to use that so you can trade with percentage of success, even as low as kind of 50% success. So you are 1-to-1, but you're still making money. So our second level of risk management is learning how to choose the right stocks. Now, if we learn how to choose the right stocks, we're still going to apply the first level to the second level, right? So we're only going to look at the right stocks, and this is where accuracy comes in, the trade accuracy. The next thing we'll get into is how to find patterns. And we find patterns on the right stocks, and we're going to use the right risk management techniques. So we're going to keep building on what we're learning. We're going to use risk management, choosing the right stocks, and choosing the right patterns. And then we're going to talk about the actual strategies that I use to trade every single day. Okay, so that's it for this lesson. If you've got any questions, and you know, just shoot me an email, tony@hustlewithtony.com, and you know, we can. I'll get back to you pretty promptly, and join me for the next for the next lesson. Here's my email. The next lesson we're going to talk about setting up your charts, your daily chart, understanding triggers, and recognizing windows. So join me for that lesson, and I hope you got a lot out of this lesson. Thanks a lot for joining us.